Ladies and gentlemen, the coronavirus hits the emerging markets differently than the developed economies. Emerging markets cannot afford to slow down their economies the way richer countries do. This would prompt social unrest. Instead, emerging markets are hit mainly by the lack of demand from developed countries. In the emerging market, it is not the supply effect but the demand effect that dominates. This means that corona tends to lower inflation in the emerging markets. This is good news for these countries, because then currency devaluations do not lead so quickly to higher inflation, which in turn leads to further devaluations and in the end to an inflationary devaluation spiral. The reduction of this risk gives the central banks more leeway to combat weak demand with interest rate cuts. However, this does not eliminate the risk of a depreciation crisis for all currencies. The currencies of countries that are heavily indebted abroad and also suffer from unresolved domestic problems remain at risk. By this I mean the so-called fragile three, that means the Turkish lira, the South African rand and the Brazilian real. Thank you very much for your attention.